Welcome to all of you. Thank you Outlook for giving me this opportunity. Uh, See, the biggest lesson that we've learned in equity investing over the years is, people always say knowledge, but the biggest lesson that we have learned is that temperament is the most important. And if you're able to handle temperament, actually, there's a lot of money waiting to be made over the next few decades in investing in equity. Warren Buffett has long told that, the highest IQ doesn't yield you the biggest returns in investing. And so somewhere when people tell you you have to make money in equity, you need the highest level of knowledge. What I've learned from reading about Warren Buffett and all the great investors in America and elsewhere over the years is that the first thing that investors need to focus on is actually temperament. Because see, if you go back and think introspect, you will find that it was very easy for you to know that in 2007 you had to be cautious because markets were costly. In 2008, when markets were down after Lehman, you had to buy. And if you go back to recent periods of time in 2020, when COVID hit and the markets crashed, it was very easy to know that you had to buy. And in recent times, because markets had done very well, you had to be cautious is something which was very easy to know. But if you look at how investors behaved, it was exactly the opposite. In 2020, most investors found it very difficult to actually buy. And if you go back to the environment, let's say 3 to 6 months back, it was very difficult to persuade people that equity market carried risks. That's why on the eve of Diwali, actually we gave an interview saying that equity market is not a fixed deposit. Because the fact is that, temperament is possibly the most important thing in investing. And I would say that if you had to think of a top strategy for all time, I would say temperament would be the top strategy. The second, I would say, is very, very easy. Actually, most people, when they spend money, let's assume they decide they're going to buy a two-wheeler for 50,000 rupees. They would normally ask older holders of that two-wheeler, let's say, and ask that particular older holder, are you happy with that two-wheeler? Or if you're buying a car, you would ask that car owner, any other person who had that particular brand, whether they were happy with that car, and that would be a decision, let's say, of 10 lakh rupees. But very few people, I have seen too many people taking decisions on the phone involving 10 lakh rupees to buy stocks without doing work. So to reduce that kind of impulsive decision making in investing, particularly in stocks, one of the equity strategies that I've always recommended, which again is very, very simple, is that you create a journal, and it can be a Word document, it can be a notebook, it can be anything that you feel comfortable with, where before you take any decision to invest, you will write 3 to 5 lines on why you're taking that investment or disinvestment decision. It could be that Naren told you to buy on TV. It could be X told you to buy. But at least you will write 3 to 5 lines before you invest any amount of money in anything. And you will maintain that notebook or Word document carefully for years. And then look back over the years, what did that journal actually tell you to do? And I would say that it is a strategy which is likely to give you good benefit, because over a period of time, you will realize whether Naren gave you always bad investment ideas over a long period of time, or whether X, your good friend, actually gave you always very, very bad ideas. And actually, if he told you to buy, you should have actually sold. Or what kind of benefit you got, or what process you had followed actually helped you to make money, or what process you followed hurt you. And but you have to maintain that journal, and the journal cannot be lost. So if you buy a notebook, you have to store that notebook. If you write a Word document, you should keep that Word document. Because these mistakes or these correct decisions, you should be able to introspect over years. Because the right investment decision is not something where the returns come in 1 month or 2 months. It happens over years. So I would say a simple thing would be to maintain a simple, and you don't need to write 100 lines. Deciding why you bought the share, it should be maximum 5 to 10 lines. But that 5 to 10 lines have to be, and people have asked me, when you maintain this journal, can it be done after the event? I tell them, no, it cannot be bought after the event. It has to be written before the event. Because the moment you start making it after the event, then you will forget about it. You will not do it. Whereas if you create that journaling process before the event, it will turn out to be something beneficial. Whereas if you make it after, I'm sure one of the days you'll stop doing it, and then it will not work. So I would say it's a very simple process. Does it cost money? No. It costs one notebook or one Word file. Word file doesn't cost you anything, but I would say this is a second, I would say. And these are strategies which are likely to work. Have I seen successes for people who have used this journaling model? I've seen big successes. How many percentage of the people have followed it of the people I've recommended? 1 out of 5. And, or 1 out of 10, I would say. But that 1 out of 10 has succeeded, and they have specifically told me that it has been a big success. And almost everyone who has followed it rigorously have found it a big success, actually. The third is what my guru Howard Marks told me about. He said at any point of time, you have to ask one question to yourself. See, at all points of time, we want to make money. That I agree. But if you ask me, you have to ask yourself whether you want to make money or you want to actually protect your money. And markets are such that there are times when you have to protect your money, and there are times when you have to make money. So, when markets have delivered huge returns, normally the goal should be to protect your money. And when markets have delivered huge losses, actually it should be to make money. And what Howard Marks, my guru, says is, you have to first define at any point of time which of the two goals you have. Whether your goal is to make money or whether your goal is to protect money. So as I meet you today in February 2025, the goal has to be to protect the money you have made. Because anyone who has invested, for example, in equity in the last 5 years has made money. Anyone who has invested in real estate in the last 5 years has made money. Real estate is trading at the highest price possibly all over India. And anyone who has invested in equities also has made money over the last many years. So today the goal has to be to actually protect the money you have made. Whereas if you go back to 2020, real estate in the last 7 years from 2013 to 2020 had delivered almost zero returns. Equity had done very badly. So the goal in 2020 should have been to make money. It cannot be to protect money, because for 7 years, 2013 to 2020, real estate had delivered no returns. And the entire goal was actually, should have been in 2020 to make money, because in the last 7 years, you did not make money either in real estate or in equity. So the decision whether to try to make money or to protect money should be based on whether people have made a lot of money or actually lost a lot of money. So if people have lost a lot of money, then I think the goal should be to try to make money. But instead, if people have made too much money, then I think the goal has to be to protect the money. This is what my guru Howard Marks says. So suppose you are in United States of America and you have made huge money in the technology stocks. Today the goal should be to protect the money. Whereas if you are, let's assume, in Brazil, where for 10 years the return has been negative and you have made no money, the goal has to be to try to make money. And that is the goal that has to be, because for 10 years in Brazil, you lost 20% of your return. In 10 years, the return was minus 20% in Brazil. So the goal has to be to try to make money in Brazil. Whereas the goal, if you are in US and you are in all those FANG stocks, has to be to protect the money you have made. So coming to the environment, and this is something where I must thank Outlook for giving me this opportunity. See, I'm a person who has spent 35 years in financial markets. So what is worrying me at this point of time? What is worrying me at this point of time is that the entire risk today in markets is being taken by investors. I started working in 1989. At that point of time, all the risk in the economy was being taken by development financial institutions. Between 92 and 95, all the risk was taken by the investors. Then after that, in 2007, 8, 9, all the risks were taken by corporates supported by banks. Today, you'll be surprised, all the risks are taken by investors. Today, if a company wants to buy any other company, they buy the company, immediately do a qualified institutional placement and investors invest in it. Does the company borrow money for it? They don't borrow virtually. They just issue equity and raise money. So the investors are investing. Do banks have to finance most of the projects? The answer is no, because most of the projects are funded by the equity market. Most of the private equity investors sell the equity to investors. So all the risks are taken by you. This means that all the investors in India have to be very careful, because the investors are taking the risks in the market. The companies are comfortable. They are very, very comfortably placed. Banks also are not lending to corporates, because corporates don't need the money. Whenever corporate needs the money, they come and do an IPO. You should see how many IPOs are happening. Even the smallest company, which is a very, very small company, manages to do an SME IPO. You'll be surprised to note what I've heard from many of my friends today. Companies which don't even get listed are able to raise unlisted stocks from many investors. So the risks are being taken by investors. In my opinion, do the investors know that they are taking so much risk? I do not know. But I worry about it, whether they know that they are taking all the risks that are there. And the issuer is not taking the risk. The investment banker is not taking the risk. Mutual fund is also not supposed to take a risk, because what happens to a mutual fund is that a mutual fund is someone. Suppose you give me money in a small cap fund, I invest in small cap stocks. If you give me money in a mid cap fund, I invest in a mid cap stock. So I am also not taking the risk. So when I think of top strategies for all of you in the equity market, what you should know is that today all the risks in the equity market are being taken by investors. So that is the current situation at this point of time, and you should be aware of it. So coming to the market, it's actually very simple. The small cap and mid caps are overvalued. They have never been as overvalued as they are today. The large caps are not so overvalued. Why has this happened? This has happened because FIs have sold heavily in large caps in the last 4 months. In the last 4 months, they have sold more than 1 lakh crores of large caps primarily. So the mid caps and small caps are very overvalued compared to the large caps at this point of time. The mid caps and small caps have never been as costly as they have been today at this point of time. And barring maybe 2007, I don't think there has been a time when mid caps and small caps has been as overvalued as they are today. And we have a situation, so what we do as a house is, as I mentioned, considering that we believe that investors have to be more careful today and they have to try to protect the money in equity, we have been recommending asset allocation. What is asset allocation? Asset allocation involves investing in equity. It involves investing in debt, which no one wants to invest. It involves investing in REIT, InvIT. If you can invest in global stocks also, because with the exception of NASDAQ, most of the other markets have done very badly. Could be investing in gold and silver, but they have done too well. So asset allocation is investing in everything at this point of time, and not just equity. The best equity strategy today is not to put all your money in equity, because putting all your money in equity, particularly in mid-cap and small cap, is extremely risky at this point of time. What is worse than investing in mid-cap and small cap is investing in SME IPO. It is investing in unlisted stocks. Those two things are worse than investing in small cap and mid cap, but small cap and mid cap is also pretty risky at this point of time. And what we have seen is that over a period of time, people used to tell us, you always recommend asset allocation. Why do you recommend asset allocation? How will asset allocation do against small cap and mid cap? But what we realized is that, and here we have not used our funds because that's something that Outlook does not want us to market any of our funds, and that's the right thing to do in a forum like this. What we found is that the categories itself have delivered very, very decent returns despite not taking big risks. Because asset allocation as a framework is doing something which is good temperament, which is buying the asset class which has done badly and selling the asset class which has done well. And consequently, it turns out to be one of the best methods of investing for the long term. And it is not investing all your money in only equity at this point of time. So if you look at, for example, the multi-asset category, it has delivered a 3-year return of 13%. The aggressive hybrid has delivered a 12.5% return. And this is in a bull market. It's not a market where equity has delivered bad returns, whereas Nifty has delivered a return of 10%. With the exception of the mid-cap index, which has delivered a huge return, it has delivered very good returns against everything except the mid-cap index. And that's why we believe that that is the best equity strategy to follow. Asset allocation is one of the best equity strategies to follow. And within the entire equity space, large cap is about the best area to invest in. No, people ask me, you keep saying this, but is there a problem with Indian macro? The answer is no. Indian macro is in good shape. How do we define Indian macro? We look at Indian macro by looking at fiscal deficit, current account deficit, and inflation. In all these three parameters, I would say that India is in good shape. There is no problem there. But the problem is that valuations are not cheap. And specifically, the mid and small cap areas are very expensive. And people have been very exuberant, which is the reason SME IPO and people are buying unlisted stocks. And we believe that one of the things that people have to remember is that SIPs have to be invested in cheap asset classes and in volatile markets. What people think is SIP invested in costly asset classes can give good returns. So what we always recommend is invest SIP in cheap asset classes. What would be the cheaper asset classes today at this point of time? Would certainly be large cap, hybrid, flexi cap at this point of time. So if we have to choose SIP at this point of time, we will choose large cap, flexi cap, and hybrid at this point of time, because we think that what people don't realize is SIP in costly asset classes doesn't necessarily lead to good returns. If you are invested for 20 years, it doesn't matter. But if you are invested for shorter periods of time, whether you are investing in a costly asset class or a cheap asset class, makes a difference. It'll take some time for you to understand this because SIP is still an investment and SIP is not an FD. So that's why you should invest SIP in a cheaper asset class. And today, large cap, flexi cap, and hybrid are cheaper than small cap and mid cap. So what we like at this point of time is asset allocation, large cap or flexi caps. These are the things. If you are not in the tax bracket, I think debt is to be also considered. For the last 3 years, no one has looked at debt. For people below the 12 lakh limit that has been done in this year's budget, clearly debt has to be considered. So in our opinion, equity strategies at this point of time have to be large cap focused, asset allocation focused, and against small cap and mid cap, and against unlisted and SME at this point of time. Thank you for Outlook for the opportunity to talk to all of you. And so please remember, temperament is important. Journaling is useful. Think whether you're trying to make money or preserve your money. And I believe this is a time when you have to be a bit more careful than you were in 2020. But India remains a good structural story. So look forward to long-term returns, but with volatility. Thank you all.